Good morning everyone, and welcome to this video where I will try to explain the concepts behind my trading strategy, which you can also find in more detail in the book that as you know is available for sale on Amazon, both in paperback and Kindle format. With this brief introduction out of the way, in this short FI, in these videos that I'll be sharing, I'm not sure yet exactly how many will be needed. I'll try to explain a bit the fundamental concepts of my strategy, how I choose the direction in which to trade, and what concepts I consider when making my trading decisions. So first of all, let's start from the premise that my trading style is very simple. I identify swing points and, well, I buy and sell at these points that I identify with my algorithm, which extracts these points based on volumes, specifically volumetric patterns, and, well, it draws these lines on the chart. But let's go step by step. Starting from the basics, let's begin with the fundamental concepts of my strategy. As I was saying, it's very simple. I just look at the chart for what it is, basically. So when we evaluate a trend, we always need to assess it based on which time frame we're looking at in order to understand the strength of that movement at the moment we're about to trade. We always have to keep in mind that trends, obviously, there are higher order trends, so it's always good to be aware of all the main reference time frames. I'm referring to the weekly, the daily, the hourly, and then we go into more detail with the 5-minute chart. So with these 4 time frames, we can get an idea of the current trend. If all 4 time frames show an upward trend, we have greater certainty about the directionality of the asset we are following. Obviously, this is a very particular situation and it's rarely found. So we need to be good at trying to understand the momentum and the market environment in which we're operating. By market environment, we mean, of course, the directionality of the day and what the current trend might be based on the time of day we are trading. If we are close to news releases or the publication of important macroeconomic data, we always need to contextualize the momentum in which we're operating. That said, another simple concept is that, of course, to evaluate everything, I use technical analysis. Technical analysis introduced by Dow Jones tells us that a trend in progress is formed by higher highs and higher lows in an uptrend, or conversely, a downtrend is formed by lower highs and lower lows. Obviously, we know that the market alternates these phases of upward or downward movement with phases of lateralization and therefore price consolidation. We can define it however we prefer depending on when this occurs. So we know that the market has these phases of expansion and alternates with phases of contraction during which the price moves sideways. So we know how, let's say, the price moves, what the price dynamics are based on this. This is the reason this is a chart of the Nasdaq, what you see here, a chart from yesterday. That is a real-time chart. Let's take, for example, what happened yesterday, the 7th of July. We can see that initially during the morning, the European session, basically from the opening, that is from the opening of the regular trading hours, the price started to decrease. We see lower highs and lower lows. The price went down, then there was a slight reversal. Here the price made a high, then a lower low than the previous one. The price went up, then another lower low. You can see how these phases alternated. It moved sideways for a bit, then surged upward again because it didn't make a new low. If it had broken through this low, then it could have been a potential reversal. You can see that then it went up, and when it went to retest C, here it already broke through a bit. It went up but couldn't reach the other highs and went back down again. Same thing here, it didn't even get close to touching here and went back down. So these are phases where I, for example, prefer to trade short, or vice versa. Like here, when this double bottom formed, we broke the PV. There was a retest of the PV here. It was a clear indication that the trend, let's say, from descending was starting to turn a bit more bullish, and here was another opportunity to go long. You can see how the price goes up, comes back to test the lower levels, the lower highs, and continues its movement. These are the phases you need to learn to identify, and it's actually quite simple. You just need to zoom out a bit during this phase yesterday from, well, just before the market opened. You can see it made a high, then went on to break the previous low. It settled here during the opening phases. There were attempts to move upward, all of which failed, all with wicks. Okay, the price went down and made another attempt to go up. Here it was completely rejected. You see how the highs held, they weren't broken, and the price went down. Another bounce. In this another bounce, in this phase, the previous high wasn't breached. Down again. Then from this high, which was from a new bounce, because in this phase there was a bit of sideways movement, there hadn't been a new breakout above the highs, and the price went down again. Here there was the bounce, a breakout of the previous highs, a minimum during the sideways phase, a retest of the lower level. It didn't manage to break the previous high, and the market started to recover. Then basically since last night it began to recover, and now, well, it has recovered. Here too, as you can see, it made a new high, but even in this phase it kept making again. Higher highs and higher lows indicate an upward trend. In these phases, I wait for the retracement and go long at the first, obviously, on the previous high when we are in an upward phase. And of course, when the price retraces here to the previous high, the fact that the previous high is not broken tells me that basically I can safely go short again in the direction of the trend I'm following. Trend in quotation marks, because we always have to contextualize it to the time frame we are following, which in this case, as you know, for trading I use the 5-minute chart. So all these phases are buying opportunities or perhaps chances to pyramid a position if the trend is strong, if it's supported by momentum. And how can we assess whether the momentum is strong? Obviously, from the size of the candlestick, the size of the candle indicates strong price action clearly from the volumes that accompany these movements. And to do this, we have various tools that we'll look at later. At this moment, what matters to me in this video, what matters to me is that you clearly understand which concepts are the ones that make me decide which directionality to use, which directionality to take. Of course, when it comes to entry points, we use levels to help us, but obviously all these concepts I mentioned to you, lower highs and lows, the whole concept of testing, it's all here. When a high is created, it tends to be tested afterwards. If the previous high is not broken, it means the direction is still short. If the previous high is broken and then retested from above and holds, obviously there's a reversal and we position ourselves long. We don't need to be the first to enter or the last to exit. The idea should be to try to capture the comfortable part of the trade. So the moment I confirm that the reversal is underway and there's confirmation with the break of a previous high or low, that's a reversal. And so I position myself in the opposite direction. But in the moment when, as in this case, as I explained to you, the dynamics of this trend that maybe started yesterday, well, from just before the market opened yesterday until the evening, okay? You have to interpret it this way, with lower highs and lower lows. So I know that I wait for a retracement at a good point, and to do that I use my levels. Basically, when a retracement comes close to my level, I position myself short in the direction of the trend with a stop loss beyond the level, so that if I happen to be wrong, I still have that protective stop, which tells me that there might be a price reversal happening at that moment, a trend reversal, and so I'll switch my strategy from short to long. Basically, the stop loss here, as I say in the book, is the cost of our trading activity. In other words, is the price we pay for information, the cost of information we pay to the market to find out if our intuition was correct. So we shouldn't regret it, because sometimes in order to understand and then operate in the right way, the stop loss is actually necessary to help us understand which direction to take. That's why stops shouldn't be ignored. We need to ask ourselves why that stop was triggered when it happens, because that's exactly the information we get from the stop. The stop tells us that we got the direction wrong at that moment, or we got the timing wrong. It could even be a timing error in the trade itself, or maybe in setting the stop loss. So we need to analyze it when the stop is triggered, because I repeat, the stop shouldn't be a cost we pay for nothing, but rather a cost that gives us the information we need to recover from it. So these concepts must be absolutely clear. As we were saying, besides these concepts, these very simple concepts, really of uptrend or downtrend or sideways movements that we can identify, like this one, for example, which happened at the open with ups and downs, but without any strong directionality until the market eventually broke the previous low and went a bit higher. Well, it was an attempt, but then it went down because it couldn't break out of the range on the upper side. So based on the momentum, or rather the situation we have in front of us, we need to choose our type of trading approach, either swing or in the direction of the trend, or range trading. That means going short at the top of the range and long at the bottom of the range. Obviously, trends don't let as say they come to an end and complete themselves when, well, reversal patterns start to form. These reversal patterns can easily be identified, just as I show in the book, with alerts that trigger at that moment, like I've shown you here or explained earlier. We had a bit of sideways movement after the breakout with a new low being made, then there was a rebound, okay? With the break of the high, this is a first alert. This is a first alert that tells us the trend is about to change. After that, the market pulled back, but didn't immediately go to test even the lower lows. It didn't make new lows. So even here, this push was quite predictable. There was a new attempt, but this one was blocked as well. This could have been a bit misleading because there was a lower high compared to the previous one. As you can see, the market went down, but then was stopped again. Here, if it had reached this point and broken through, it would have meant that the trend would continue downward, but since it stopped here, once again, we have a lower high. With the break of this level here, the market then started to rise and recover levels, almost reaching 23,000, as we can see here. So these are the concepts. Here too, this pullback shows us that this is simply a price correction. Then in the next video, I'll show you the more complex corrections, the ABC corrections and my reversal patterns, but I think it's best not to I don't want to make the video too heavy. I want to introduce these small concepts little by little so that you can really grasp them clearly. Momentum also needs to be read, just as you see here, where the momentum was clearly favoring the downside, because we have candle 7. If we switch to, say, a 2-minute time frame and look at the same downward momentum, you can see that the candles, and by momentum I mean this, you see from small negative candles they start to grow in size. So this was telling us that the momentum was to the downside, so it was a clear opportunity to exit the range. Whereas here, look, the candles were almost all wicks. Here the candles started to gain body, which means that volumes were starting to come in and all in the same direction, breaking through the level. So it was a great opportunity to go short. Then when you reach this level with this nice bounce, almost forming a harami, it could have started to signal a possible reversal. In fact, what happened next was this initial reversal, let's say, was invalidated because there was a lower low, but then the new bounce broke through the previous highs. With this candle, there was indecision as the level was retested and they were unable to break it, so the market started to move upward. So at this point here, when this candle broke through this level, going long here at 28.35 meant taking the easy part of the range up to 50, then 40 or 50 points to the first upper resistance level. And with this, I'm simply showing you with technical analysis what we can achieve. And then, as we'll see later, with the addition of the levels, because as you remember from yesterday, these were all, there were, well, some levels from yesterday's string that then match up. So we have an additional, a further target. So these are the concepts at the core of my strategy. Technical analysis, candlestick analysis with reversal patterns, including candlestick patterns, doji basically. In the book, I list the ones I use, the ones I pay attention to. I look at the engulfing patterns. The engulfing is the one that, of course, completely engulfs the body of the previous candle, as has always been the case here. This candle did exactly that. This black candle completely engulfs the body of the other one. It totally swallows it up. So this was a clear sign of reversal here. Basically from 9.16, if you wanted to take the whole move down to 8.5, or without even pushing further down, even 8.6, or would have been another 30 or 40 points, all from a simple candlestick pattern. The same goes for hammers or hanging man, which you can easily find if you look online. There's plenty of literature, and as I mentioned, they're also listed in the book where I show you how I use them. I don't use them alone to make a trading decision, of course, but they support everything we've discussed based on technical analysis, and obviously they're coordinated with my levels and other parameters like volume pressure, which is part of one of the pro or premium indicators. These are 2 tiers of the service I offer. Perfect. We've reached the end of this first video. As I said, I don't want to overload it with too many concepts. I hope it can be helpful to you. Of course, another one will be coming tomorrow. I'll try to make one a day, trading permitting. With that, I'll say goodbye. As always, I invite you to leave a like on the video, follow me on social media, and we'll catch up later in the chat. Thanks to everyone for your attention.